Good afternoon, everybody. My name is Mark Thomas. I'm Head of Investment Companies here at Hardman Co. and welcome to the latest edition of Hardman Talks. Very pleased today to be joined by Helen Steers, partner at Pantheon, who's responsible for Pantheon International, and we're also joined by Vicky Bradbury, who heads their investor relations team. Helen, welcome. We'll have a number of the viewers who will be very familiar with your business, but we'll also have some who aren't. Perhaps you could just give us a brief overview on Pantheon and on it.
Good afternoon, Mark, and it's a pleasure to be here with you today and with everybody else on the line as well. So just a few words maybe about Pantheon. So Pantheon is a highly experienced private markets investor, almost 40 years actually of the experience of investing in private equity globally. The firm manages around $58 billion on behalf of an array of institutional investors, and they range from sort of pension funds, insurance companies, endowments, foundations, and indeed individual investors. But many of these institutional investors have actually been Pantheon clients for many decades. From this chart, actually, you can get a sense of the scale and the reach of Pantheon, not just geographically, because we are a global business with offices right over the world, but also in terms of our scale and reach, the number of relationships we have. We need this sort of scale in order to gather the information, the knowledge, and develop the deep relationships which are so necessary to sort of solve deals and create value for investors in private equity. So our platform, our network of relationships with the sort of best private equity and venture capital firms in the world, and our sort of privileged position on these advisory boards gives us a huge competitive advantage as we seek to make investments in private equity. Also, last but not least, we're a leader in ESG, having been one of the first signatories to the UN PRI in 2007. So this is a FTSE 250 London-listed investment trust. It's been managed by Pantheon for over 33 years now. And our mission at PIP is really quite simple. It's to make the private public. So providing investors with straightforward access to high-quality private equity and venture capital opportunities in a liquid and accessible way. So if you look at the pie charts at the bottom, just under half the portfolio, in fact, is composed of direct investments in private companies. Some of them come through co-investments, and some come through secondary direct investments. So that's in the pie chart. These companies have actually been through a sort of double quality filter because they've been through the private equity manager selection process and then also through the company process. The other half of the portfolio is a funds portfolio, and that's composed of the very best general partners, the best private equity and venture capital managers in the world. And often they are access constrained and invitation only, even for institutional investors. PIP provides really an all-weather portfolio to investors. So it doesn't chase after hot trends in terms of stages or in terms of sectors, although I will talk about some of our favored sectors. But it really invests behind long-term thematic shifts in the economy. For example, digitalization, which was underway long before the COVID-19 crisis hit the world. It's delivered market-beating returns over long periods of time through really sort of good choices of industry sectors and also stages, but always with a focus on very high quality. And I guess we'll go into the sort of sectors in a couple of minutes. But in terms of the stages, we focus really on the small and mid-market buyout stage and growth. And the reason for that is that's really where we think we can see the most value, the most opportunities for value creation, and also the best exit opportunities in the future.
I mean, the slide sort of shows IT as your biggest sector. Perhaps you could just tell us a little bit more about that. And obviously, it's one of the hot sectors at the moment.
Well, it is, and actually, it's probably worth spending a little bit of time on sort of the overall, sector split of the portfolio. So you're right, Mark. About 29% of the portfolio is actually in information technology, which is a very diverse sector, and I'll talk about that in a second. But we also have 19% in healthcare, and we have 16% in the consumer sector, but that's very much orientated towards sort of e-commerce, online services, with some in consumer staples, so really away from consumer discretionary. And as you can see from the chart in the middle, the bar chart in the middle here, we did a deep dive on the portfolio, actually for the sort of 6-month results quite recently, and we were really trying to assess the impact of COVID-19 on the underlying subsectors. About 74%, so just about 3/4 of the portfolio is in sectors that are really, not too affected by COVID-19, or actually have even been accelerated in a positive way by the pandemic. And those would include information technology, healthcare, and actually certain parts of the consumer sector. And we've actually only got about 2% in sectors that have been really impaired by COVID-19, like leisure, hospitality, and travel. And as well as pure IT, we've also got elements of healthcare and consumer, which are really impacted by digital transformation. And I've got some examples of that on the page. So apart from companies that produce software or software tools, actually like a JFrog or a Cerner source, we've got companies that are involved in things like digital payments. So is that financial and business services, or is it information technology? There's a bit of a cross section between the two. In healthcare, we've got sort of digital health. And then in consumer, we've got things like sort of consumer marketplaces, Allegro, for example, which is the Amazon of Poland. So it goes a bit beyond sort of pure IT, and it really goes into sort of those sectors that are being disrupted in general by changes in the economy and the macroeconomic environment.
Very helpful, thank you. And sort of tech enablement and technology, we outlined some of the advantages, but perhaps to misquote Mrs. Merton, what was it that first appealed to you to this multi-billion-pound sector?
So I think there's really 4 key reasons, Mark. First of all, tailwinds. They're huge macro tailwinds which have really helped technology, and that's this drive towards digital transformation, which I mentioned before. And then resilience. This is a highly resilient sector, and not just through the COVID crisis, although obviously the move to remote working and automation and all of that has helped the technology sector. But even if you look back at the GFC in sort of 2008, 2009, if you compare actually in the public market, S&P 500, non-software, non-data companies with software and data companies in the S&P 500, you can see that the revenue growth of those companies that were software orientated, was 2% through the crisis, with EBITDA of 5% increase, whereas non-technology companies saw a 5.7% decline in revenue and a 4.4% decline in EBITDA. So, resilient in the GFC, and then of course in COVID it was even more pronounced. Non-software companies had a revenue decline of 2%, EBITDA decline of about 1%. But the software companies were tremendously accelerated, almost 7% in revenue growth and 10.6% in EBITDA. So very resilient in difficult economic times. And then the third point is really diversity, and we sort of mentioned this before, but it's a highly diverse sector, and it's constantly sort of moving and changing. There's lots of really interesting niches to invest behind. So it's not just one sector, and really a horizontal across lots of different underlying sectors as well as a vertical. The fourth point is that in technology, there are just multiple drivers of value creation. We talked about the growth of some digital assets and increased connectivity globally, which provide these tailwinds. But tech-enabled businesses are really scalable. They can grow very fast, and they can grow globally rapidly. So that makes them attractive for private equity. Also, low capital intensity and very high returns on invested capital. So these are asset-light businesses, which makes them attractive. And then probably lastly, sort of predictable and high recurring revenues. So this all makes it very attractive for private equity investment.
And you said in your sort of introduction that you don't chase hot sectors. Has the pandemic changed your view at all in terms of technology and particularly tech-enabled. I mean, to me, the actual tech-enabled is one of the things that's sometimes missed. So, across the border space, it would be really interesting. The views changed.
No, I think if anything, I think the last 12 months have just sort of accelerated, the trends that were already happening. So these pre-identified trends were just given a huge boost by what's gone on during the pandemic. There was actually a really interesting study from McKinsey that was published at the end of last year, which talked about the huge acceleration of sort of the implementation of change due to COVID and how businesses had to become tech-enabled, to your point, very quickly. And, in terms of, for example, offering an online consumer experience, whereas before a company might have thought that would take, I think the average was something like 560 days, so like a year and a half to produce an online consumer experience. That got accelerated to less than a month, 22 days. As well worth reading that McKinsey study because it gives you a lot of insight, I suppose, into the impetus behind these trends. And then, if you look at some of the other information that's been published on even just the software sector, you'll see that Gartner, for example, has predicted that global software spending will hit about $750 billion by 2024. So, there's a lot of capacity there to find interesting business to invest behind.
I suppose, we are actually a tech-enabled sort of webinar we're doing rather than doing things live, right? So it's a real example. Sometimes brings these things to life if you give sort of a couple of companies, give sort of examples where that's actually worked in practice.
Yeah, that's probably good as well to think about not just the vertical, but also the sort of this horizontal. So we've got a slide that shows sort of technology as a as a vertical as well as a horizontal. So I've talked a little bit about IT itself. We've got a couple of examples here. Maybe I'll go into that in a bit more detail in a couple of seconds. But in terms of some tech-enabled, business and financial services, for example, we've got a couple of companies here on the page, Adyen and Nexi, that people might have heard of. These are digital payments businesses. And of course, with the rise of e-commerce, these companies have been hugely accelerated over the last 12 months. But even in some of these other sectors, healthcare, for example, a company here called Four Ways, which provides radiology solutions that you can use remotely. It's a UK company, and that enables NHS radiologists to carry on providing diagnostic tools during the crisis. But even in the industrial sector, technology is making a huge impact. We have a company in the portfolio called Armis, which is in the Internet of Things business. So they provide the software that controls robots in factories, so enabling automation. I mentioned Allegro as a sort of consumer e-commerce, but we've also got a company called Wayfair, which again some people may have heard of. It's a home goods business that very quickly moved completely online last year, and it provides furniture and other sorts of home goods in the US, Canada, UK, and Germany. So those are just a few examples of the way that technology is really sort of permeating other sectors, not just information technology and software.
And I suspect any of us who watch TV will be very familiar with Wayfair. So a perfect example. Obviously we've spent quite a bit of time on technology and tech enablement there. You clearly have some other defensive sectors, some other good robust sectors. Perhaps you could talk a little bit about those.
Yeah, so in addition to IT, we were a big investor in healthcare. As you saw, it's 19% of the portfolio. Quite varied. Again, it's a varied sector. And just to maybe bring it to life a little bit, I'll pick out a couple of companies. KD Pharma, interesting business. It's the leading global producer of omega-3 ingredients. Now, to you and me, Mark, that's probably better known as fish oil.
Yeah.
And it's tapping into this trend towards sort of healthier lifestyles. It's what they call a nutraceutical. And the company itself, very interesting, integrated supply chain with all sorts of margin benefits there. Very strong brand. It's actually German business, but it's opened facilities as well in the US. And that company clearly has done quite well over the last 12 months. We're an investor in there through this sort of a direct secondary, sort of directly into the company there. Really, really interesting business. I mentioned Fourways already. That's the remote radiology business. Maybe to pick another company that we've actually exited from recently. That was a co-investment, Qualise, alongside IK Investment Partners, and that's a company which is really the leading European operator of nursing homes. And interestingly, it's really consolidated what was quite a fragmented market. It's got very high ESG standards, and the company was exited actually about 3 or 4 months ago, in the depths of the crisis, in fact, for a very nice return for us at PIP and for the investors in general.
Great. I mean, I suppose the bottom line, and this is where the analyst in me comes out, is what do investors get from it? Yeah, it's clearly you've had excellent long-term performance and returns, but can you give us a bit more on what the investors have got out?
Well, it's very important to dig into the underlying businesses, and we can talk about sort of the top line at PIP in a couple of minutes. But in terms of the underlying businesses, these are growth businesses. So if you look at the revenue and the EBITDA growth over the last 12 months, and these are numbers that we produced for our 6-month interims quite recently, you'll see revenue growth at the underlying business level for the buyout companies was 17%, EBITDA growth around 15%. And remember, these aren't the sort of the very high octane, venture businesses. This is sort of what, people kind of term boring buyout businesses. That doesn't look so boring to me. And yet, the valuation multiples are pretty much in line with the MSCI. So you're not paying a lot more. In fact, you're not paying any more in terms of the valuations for these businesses. One area one statistic we keep a very close eye on is valuations, and this sort of valuation uplift at exit. And you can see that on the top right-hand bit of this chart. So we look at, the exit that we get from a business, the realization, the cash we receive, and we compare that with the valuation 12 months beforehand, which is really the undisturbed sort of valuation. And you'll see that on average, when we exit from a company, we exit at 20% more than the last holding value. So a lot of embedded value in the portfolio as well, which I think gives me confidence for the future. And then the distribution rates have been very good. If you look at the distribution rates, even over the last few quarters, pretty strong. And that's enabled us to generate the cash that we can then plow back into new opportunities. So I think for come back to your question, Mark, for investors, extremely good long-term results. But also, I think even if you look at the current portfolio, it should give investors confidence about the quality that we've got there.
I mean, roughly speaking, when I was looking at it, you got returns which were about twice the FTSE All Share over 5-10 years.
No, that's true. Very strong returns, and market beating returns over 5 and 10 years. And also we've got the returns here since inception. PIP has been around for 33 years. It's weathered a number of cycles, economic cycles in that time, and it's produced 11.7% net return per annum over that period of time. So strong returns, and the company's in a strong position. And you can see the balance sheet on the right-hand side, very strong. We've got cash on the balance sheet plus available financing, extremely good coverage of our undrawn commitments, and that means we're in an excellent position at the moment to be able to take advantage of this very strong pipeline of opportunities that we've got with some of the companies that we were talking about earlier, actually.
Yeah, very, very strong returns. And I mean, I suppose so far we've really focused on sort of sectors, sort of technology and healthcare, etc. And obviously we've got a very, very long-term performance. But what else has actually helped deliver that performance? I mean, it's that really, really strong performance.
So I think it's you're right, Mark. It's not just the choice of the sectors; it's also the choice of the managers that we partner with. So whether it's directly in the companies or in the funds, these sort of hard to access funds. The private equity managers themselves, there's a big dispersion of performance, as everybody knows, in private equity between the very best managers and sort of third quartile managers. Clearly here we're focusing on the top quality managers, and these managers are really able to convert opportunities into great deals and then add value along the way. So the best private equity managers are very nimble and flexible. They have huge staff, operating expertise to be able to accelerate the growth of these businesses at the top line, the revenue line, and at the EBITDA line. And that's the result you can see in those bar charts I showed a little bit earlier. And that's sort of a little bit the secret sauce of private equity as well. It's this sort of hands-on support to the managers in the underlying companies, alignment of interests, making sure that everybody's working in the same direction, and there's long-term focus so that people are working towards, an exit horizon of 5 or 6 years. It's not about the next set of quarterly results like you tend to get in public markets. So that's why the private equity model, I think, works so well, is because people are all pushing in the same direction and they're all incentivized to grow the businesses and create a lot of value in the future.
And it's so very different. I think some people perceive it as just being sort of financial engineering, asset stripping. It's a totally different, fundamental generation of returns that come from that. And we said we're not going to focus too much on hot topics, so I'm going to focus on another hot topic. Everyone's talking about it, ESG. From what I can see, you're in a market-leading position in terms of ESG. Can you just tell us a bit more about what you are actually doing?
So, you're right, Mark. We've really been a leader in ESG right from the beginning. So we signed up to the UNPRI in 2007. I think we were the second private equity signatory in the world, to sign up to the UNPRI. So we really had a very strong start. We've been, A+ rated by the UNPRI. We've been on steering committees that have set standards for private equity on the ESG side. And we've embedded it for many years now in our due diligence processes, and importantly in our monitoring processes. So every manager is rated. It's given an ESG rating, red, amber, green. The underlying companies as well. When we're assessing a co-investment, for example, very deeply into the business, but we also do the sort of ESG ranking too. And then after the investment is made, very deep monitoring, on all different metrics, but on the ESG metric as well. And we use a tool called RepRisk, which is an artificial intelligence tool. It trawls the world's media, social media and physical print media, for mentions of all of our portfolio companies, all of their underlying subsidiaries, so that we can pick up even obscure kind of mentions of ESG incidents, and then we can follow those up with the company and with the manager. So it enables us to really have a huge amount of information and a good grip on what's going on from an ESG standpoint.
I mean, it sounds like you're very actively engaged with the investee companies where you're the co-investee, and obviously it's very engaged. And we can see from the screen everything in terms of what you are doing as a company. Can you perhaps take us through a bit more about what you're doing with the managers? Because I think some people might not perceive ESG with PE managers and what you're doing in that space.
No, absolutely. I mean, we're in a privileged position because we're usually on the advisory boards of the funds. So we can bring ESG and actually diversity and inclusion as well, which is on the other half of the slide, really onto the agenda for the manager. I think nowadays managers really see ESG much more as a value creation tool, as a way of actually making the company worth more at the end of the day. It's not about avoiding harm and avoiding risk as it used to be in the early days. It's now actually a value creation tool. The best managers get that, and they also get the whole sort of diversity and inclusion topic too. So understanding that more diverse groups of people make better decisions, and that leads to better performance. So I've been doing this now for the ESG side of things, implementing it for more than 12 years with our portfolio companies, and I can tell you there's been a huge shift over time, and the openness and the willingness and the engagement of the managers is like night and day from sort of 10 years ago.
So again, it's totally different, and it's the ESG in practice, but it's also because it's a value creator for you to be strong on ESG. So it's definitely a win-win. And I mean, anybody who's read any of our notes will know that we like private equity as a sector. What can you say as to specifically differentiate you, and why should people pick PIP as the vehicle to go into invest in?
So I think there's a number of reasons. PIP has very strong outperformance. We've talked about that. Over a very long period of time, it's an all-weather performance, not chasing sort of hot trends, hot sectors, hot stages, but really investing behind long-term trends, long-term transformations in the economy, partnering with top quality managers. So I think that long-term outperformance is really key. It's a truly global portfolio. So I didn't focus too much at the beginning on the geographic split. We've got about 50% of the portfolio in the US, some of the best and most exciting private companies there. But we've also got a good chunk in Asia as well. So it's really a slice of the best private equity backed companies in the world. We're also quite flexible. I mentioned the fact that we go directly into companies through co-investments and these sort of secondary directs, but we're also into funds. And because of the sort of flexible mandate, we can shift where our exposure in different areas, which is really quite important. It means that we can get hold of the best opportunities at any particular time, and we can manage our liquidity well too. And talking about liquidity, the company went into the COVID-19 crisis with one of the most liquid and sort of undercommitted balance sheets, I think, amongst all peers. And post-crisis, if we are post-crisis, not sure that we are, but hopefully we're getting there. We see some great opportunities, and PIP is really well positioned to take advantage of that. And I suppose finally, we just talked about ESG, and PIP is managed in a highly responsible manner. And we believe that in the long run, this is going to create more value as well.
Yeah. No, I mean, as an analyst, I think the risk and reward and actually getting into the detail in terms of things like commitment, that's very clear. And as an analyst, I'd say thank you in terms of the disclosure, which I'd certainly find it extremely helpful. So, what plans have been put in place to counter any significant rise in inflation over the next 5 years?
That's great. It's a great question, actually. I would say that private equity is a long-term business, so we're always actually looking into the future. Looking sort of 5 to 7 years hence. When we're looking at a model for a company, we're looking a long way into the future. So we take into consideration general sort of macroeconomic shifts, things that we see there. But we're not investing in infrastructure. We're not investing in sort of inflation-linked type businesses. So in general, private equity is not terribly linked to sort of GDP growth or to inflation. So I think, and I wouldn't say that we're not immune to inflation, but I would say the type of sectors that we're investing in and the type of businesses that we're investing in, are probably not ones that we would be so concerned about, in terms of sort of, big rises in inflation.
So it's picking the right stock as opposed to making the big macro call.
Correct.
Well, I've got a few questions around the discount in its widest sense. I'll sort of lump them together. What kind of discount should the fund trade at to reflect the illiquid nature of its investments? Can the fund manager reduce the considerable NAV discount in any way other than buying back shares? Would you consider paying a modest dividend? Do you think that's important to the discount? So perhaps a broad question in terms of how the company views discount management.
Now, all great questions. So we're very, very frustrated by the discount. We can see the value in the portfolios. It always seems a bit odd to me, and I showed that chart earlier with the uplift on exit, which shows that on average, our companies exit at 20% more than the last full valuation. So it always seems a little bit odd to me that we've got this discount at all, in fact. And I think it's partly a sort of a perception issue. It's sector wide, as you know. Many of our listed private equity peers, trade at the same or even wider discounts. So what can we do about it? Well, more education, more things like this, actually, to try and help people understand a little bit more about what's going on within the portfolio, more transparency, more reporting, and more marketing of the shares, because we're very confident in the value of the portfolio. We really need to get out a little bit further. In terms of dividend, So PIP is very much focused on capital growth, and I hope that's sort of come through in my remarks. We don't invest in sort of yielding investments, like infrastructure or like debt. So there is no natural income really that's being produced in the portfolio. Very much focused on capital growth. So if we paid a dividend, it would have to be sort of almost like an artificial dividend, and we're not sure that's really what investors are really investing in PIP for. It's really for the growth over the long term.
I mean, certainly the work we've done is that the dividend doesn't make a huge impact in terms of discounts. And we've looked both within the sector, cross sector, across a whole series of investment companies. I'd also put the discount into perspective. I mean, it's slightly lower than average for the sector now, I'm delighted to say. But the return is maybe 15 months worth of return. And to me, it's buying a long-term investment. If you're buying into 5 years, that's icing on the cake rather than the fundamental reason to do it. Actually, it ties into what you said. Could we comment on valuation policies and any comparisons with those in the sector? Obviously, you touched on there about the uplift, which is when the cash is received. That's the real test. But just add a bit more about valuation policies.
Yeah, so we base our valuation policy on the valuations that we get from the managers. So we get regular valuations from the managers. As I mentioned, we also sit on advisory boards, so we get access there as well to a great deal of information about the underlying portfolio. So our valuations are based on the latest available valuations from the managers, rolled for cash, as appropriate. We have a valuation committee at Pantheon, which considers all the valuations that come in from the general partners. And actually, the investment managers and the IR people don't sit on the valuation committee. It's our head of risk and our head of legal and compliance that gets to sit on that. So it's a completely independent valuation committee.
A slight variant on ESG, and it actually ties into your comments about growth. What investment opportunities do you see in the increasing focus on environmental issues globally, such as electric vehicles, renewable energy, battery technology, waste and wastewater treatment?
Oh gosh, that's actually a very wide question. There's a lot of different sectors within that. So we do see opportunities. They have to be private equity type opportunities. So some of the problems with renewable type investments haven't really provided the sorts of private equity returns that we're looking at. These long-term, really sort of market-beating returns. However, we have invested in several businesses that are involved in energy efficiency, sustainability, and I can think of one co-investment that we're in that's in a filtering business. So essentially, taking out nasties before they get into the environment, but also improving the efficiency of the machines, the underlying machines that are being filtered. So we do look for those sorts of things. We've got a couple of managers in the portfolio that are focused on that, and we'll continue to look for opportunities in that area. It's clearly another very long-term, kind of trend that we need to focus on.
It's basically you would view it as any other investment opportunity. You'd look at the growth and the whole business model and the company, rather than having a top-down view of saying, we want to be in electric vehicles. That's clear. Next question. It appears there is virtually unlimited money chasing private companies today. Are the terms available on your new investments attractive enough? So, I mean, I think generically there's been some investor concerns about the amount of money that's going into private equity, and perhaps just say where it's going and how that then impacts on you.
Well, I'm smiling because, Mark, I've been in private equity now for 30 years, and I think people have always been worried about too much money chasing too few deals, and it's been a sort of perennial concern. So the whole of the private equity industry now, there's about just over $4 trillion, I think it's $4.5 trillion, which sort of pales in significance really compared with public markets. And even if you take into account the growth of the sector, you're right, there's a lot of money going into it, really because of the outperformance. A lot of investors recognise that. Preqin reckons that private equity will probably double its assets under management in the next 5 years, so from 4.2, I think, to 9.5 trillion dollars. So yes, more money is coming in, but there's more opportunities as well. We've seen this general sort of de-equitization trend in public markets. The number of publicly quoted companies has been falling, obviously not the total market cap, and the number of privately backed companies has been increasing. And that's been a trend over the last 20 years. So private equity is actually finding more opportunities. Why is that? Well, there are lots of reasons why entrepreneurs and families would prefer to go to private equity rather than going public. They can get capital, but they can also get this sort of operating expertise and ability to grow their businesses. And they can do that over a long period of time rather than sort of under the public gaze of the market. So we're quite confident that more opportunities are being developed all the time, and these are exciting opportunities. Coming to sort of valuations and where is the money in the market, I showed at the beginning that pie chart which shows that we're focused very much on sort of small mid-market and growth opportunities. A lot of the capital that's been raised over the last few years has gone into these mega funds. And if you look at what we call dry powder, which is this uninvested capital that's sort of sitting there at the top of the market, a lot of it is in these $20 billion funds. So there's a lot of cash sitting at the top end of the market. The reason why we like the mid-market is because many of those big funds are buying our mid-market companies. So it's a great exit route for us. But those large funds will still make money as well. There's a lot of opportunity out there for private equity, and I'm quite confident about that.
So it's an opportunity to exit as well as, obviously in terms of a reflection of how attractive the market is. One of them says, how do you invest in it? I don't know if that's actually referring to PIP. I think it is.
Yeah, maybe how do you invest in an investment trust? Well, it's quite straightforward in many ways. You just buy it's a publicly quoted share, so it's a share that's quoted on the London Stock Exchange, and I think today it's trading around £27. So you can't quite get four for £100, but not far off.
Yeah, so it's perfectly normal share. We do find with some of the investment trusts that some of the platforms you've got to invest through the telephone rather than being on their online service, but it's a perfectly normal share. I think that's the important message. So we've got a question: how does Pantheon get involved in working to improve the companies it invests in? How do you support the companies at the start of the first lockdown? So I think actually we could perhaps use COVID-19 as a real life example of the value added that you were talking about earlier, where the PE managers can support the companies.
Yeah, no, that was it was very interesting, but also very reassuring to see how quickly private equity managers stepped in to help their portfolio companies right at the beginning of the crisis. So they took very early action. Some of these private equity firms are global firms, so they had actually seen what was going on in China and in Asia more generally, and they were quite prepared. Actually, they sort of almost anticipated what would happen in Europe and then in the US. So first of all, they focused very much on the portfolio company staff, and making sure everybody was safe and secure, and the health and safety side of it was the important thing. And then really on the health of the companies to make sure they had enough cash, and then to help them really get through the crisis. So managing supply chains, helping them with procurement. For example, an Italian company that was sourcing certain components from Asia, and all of a sudden couldn't get the components. Alternative sources. Working with key customers, reassuring key customers, and then actually we're talking about digital transformation. A lot of the companies had to pivot so quickly to providing online customer service, online ability to source products. And the private equity firms could do that because that's the sort of thing they're used to doing. A lot of them have digital marketing experts on staff, and they deploy them with the portfolio companies. So we were really very pleasantly impressed, I suppose, by the rate of change of what went on in the portfolio companies, and by the support of the managers. And actually, the companies bounced back very quickly. Even the companies in the the less favoured sectors, were coming out of it really in the summer and really being able to address these issues. The other thing that impressed us actually was on the ESG side, was the fact that the managers very quickly sort of mobilised themselves, but also portfolio companies to help with things like sort of donations, community support. We have one company in the portfolio that donated literally thousands of beds and mattresses to New York City hospitals. I don't know if you remember, Mark, but at the beginning of the crisis, New York City hospitals ran out of hospital beds, which was extraordinary. And this company supplied beds. Another company in the portfolio, actually in the UK, geared up to help make ventilators. So there were all sorts of interesting, and worthwhile things that were going on in the portfolio.
Yeah, I think sometimes people think of PE again from the money side, and obviously, you've got the financial support and access to committed capital. I think, to my mind, one of the surprises was the strength of the operational support. And there's no way you could have delivered the revenue and EBITDA growth that you showed on your slide earlier, had you not actually had that support. The next question is, how much borrowing at the fund level do you have, and what are your thoughts on this practice? And perhaps we could broaden that in terms of a general view about commitments and overcommitments and where you sit in that regard.
So at the moment, we have a completely undrawn facility. So we have £300 million unsecured facility, which is completely undrawn, and also cash on the balance sheet. So I showed the balance sheet a bit earlier, but I think we've got more than sort of £460 million. So the fund is actually, the company is actually ungeared at the moment, and commitments between the cash and the facility plus sort of 10% of the portfolio. I think was something like 118% covered of the undrawn commitment. So we're actually in a very good position at the PIP company level. I think the question might also be getting at the underlying fund level and sort of capital call facilities. Most of the managers now do use these capital call facilities really to help manage cash flows, sort of bridge calls and distributions. So it's quite it's a well-trod path now. Most of the managers use it. We do focus on that. And when we look at the returns of the managers, we look at the returns both with and without the facilities they use. But these are short-term facilities. The underlying funds are not geared in sort of a long-term manner that you might see in other places.
Yeah, I think it's really important to look at the gearing on each of the levels here. Gearing at the investee company level, gearing at the fund. If you've got an intermediate fund level, the gearing at that level, and then obviously the gearing at the listed entity. And again, I'd say really, thank you for the disclosure you do on that. Clearly, this is from somebody who knows your business quite well. Is PIP now coping with the previous issues of too long an aged tail? So it's good they emphasise it's the historic issue.
Yes, that's a very precise and insightful question, actually. So a few years ago, yes, there was quite a long tail of older funds in the portfolio that had been built up through sort of more diversified acquisitions of secondary portfolios, funds portfolios. And we actually put together a transaction. We consolidated the shares, so the ordinary shares, the redeemable shares at that point, and we issued an asset-linked note, which actually helped us sort of rejuvenate the portfolio. So that long tail was dealt with in 2017. So I think that's sort of behind us. And now, if you look at the average age of the portfolio, it's just over 5 years. So we brought that down from the previous sort of maybe more aged side of it. That 5-year maturity is actually quite important, Mark, because that's sort of the sweet spot where we generate a lot of liquidity. Because I keep mentioning this sort of long-term view and the fact that we hold companies in the portfolio for sort of 5 years on average. So if you keep your maturity of your portfolio to about 5 years, that means you're always sort of generating these exits, the liquidity that you can then plough back into the new deals.
So, I mean, managing the maturity is a core bit of what you're doing day to day. It's a core bit of management. You are global. you're diversified. Which bits of the world are the most attractive at the moment?
Um, so we actually, our geographic exposure has not changed very much over the years. We've stuck really to around about 50% in the US, about 30% in Europe, and the rest in Asia and the rest of the world, a little bit in global too. And I don't think we're actually going to change that too much in the future. I mean, the US is the deepest, most diverse private equity market in the world. There are literally, thousands of interesting opportunities there every year. Europe has its own attractions. It's less efficient, so you can maybe find some more sort of hidden jewels. So we like bits of Europe as well. Asia is obviously very exciting, the growth in Asia. So I think, again, it's not so much about the top down, the macro. It's more about the bottom up. It's about finding the opportunities, working with the right managers, finding the right companies. So I don't think being specific about, do we prefer this country or that country is probably the way to go. It's more about the situations. And the other thing I would say is that many of the companies we invest in now, are global. Even the small companies, I mentioned with technology companies, the ability to scale and go global, very quickly. You have a company that started in the UK, can quickly have more revenues outside the UK than in the UK. Therefore, that's really a global business now.
Yeah, well, the example I use in a completely different space is to say, look at BP. Is it a British company or is it a global business? And obviously that's one of the issues. We've got one final question, same as anybody wants to pop in it, another final one up. You talk about the secondary market and that you're a leading player in it. Can you just tell us a bit more about that and why that's attractive and it's important that you actually have such a balanced presence in the secondary market?
Yeah, no, we've been a pioneer actually in the secondary market. In fact, people may not know, but PIP actually started as a secondary only vehicle when it floated on the London Stock Exchange in 1987, £12 million. So it's grown now to whatever it is, 1.8 billion in NAV. But at the beginning, it was just a secondaries vehicle. So we were really a pioneer in secondaries. The market has changed enormously over the years. To start with, it wasn't really sort of as acceptable to sell your secondhand funds, but now it's seen as a portfolio management tool. All the big institutional investors manage the maturity of their private equity portfolio by selling funds from time to time. More recently, what's happened is the rise of these sort of direct secondaries, so GP-led secondaries, where you're buying assets out of maybe an older fund in a portfolio. And some really interesting businesses. I mentioned KD Pharma earlier, but where you've got a company that's in an older fund, but you want to sort of extend the life of that business by giving it another sort of 3 to 4 years. The fund is coming to an end and needs to be wrapped up, liquidated, but you want to take that asset, that company, out of the fund, give it another 3 to 4 years, and put money behind it. And a good secondary investor like ourselves, with again, importantly, to have the relationship with the general partner, the private equity firm, is able then to back those types of businesses and give them more runway for growth for the future.
So it's a growth business that you almost helped establish, for a better description, and that puts you in a very, very strong position. We have had another final question come in, and it's always good to finish with a really positive one. So with so much of the portfolio now in co-investments compared to a few years ago, can we hope for even better returns in the future?
Well, I can't make any forward-looking statements, clearly. But we are very excited about the co-investments in the portfolio. We've had some great exits, even over the last year. Some fantastic deals in the portfolio. So we're very positive about the developments we see there. And there's more to go for. I sit on our co-investment investment committee, Mark. We're extremely busy at the moment. There's a lot going on. And we work very closely with these general partners. Some of them we've co-invested with 7 or 8 times. We're a trusted partner. They come back to us again and again. And I think it's a very attractive, part of the market to be involved in.
Brilliant. Excellent. Well, thank you very much indeed. Obviously, if there are any further questions, either contact us or Vicky, and I'm sure Helen would be delighted to answer if there are any further questions. But thank you, Helen. That was extremely insightful view. I can't believe you've been in it for 30 years.
Thank you very much, Mark. That's great. And thanks for your questions, and thanks for all the the great research and analysis that you do in the sector. It's really helpful. Thank you.
Yes, thank you.